worker. Good morning, good afternoon, and good evening. A wonderful day, all of you. Welcome to our Institution of Global Professional Free International webinar. Once again, I am Kamrul, coordinator of IGP from Bangladesh. Ladies and gentlemen, I am proud to be associated with IGP as a global member. And I feel honored to host this webinar, and it's my delight to welcome you all to our Institution of Global Professional Free International webinar. Once again, thank you all for joining with us in this marvelous session, and I hope you stay with us till the program ends. Every day, some new participants join with us, so I have to give a little concept about IGP. Institute of Global Professional is an educational institution provides social work with globally recognized. We organize our webinar training, online, offline courses, etc. by best and trained speakers and courses from all over the world. Our mission is to empower people and enhance. So we have already completed our 783 webinar successfully. Now I will be presenting webinar number 784, and the topic is business valuation, mergers and acquisition. Before starting the program, I request everyone to share this webinar in your newsfeed and social media. And don't forget to tag and mention your friends in the comment box, because your engagement encourages us to do better and best services to our lovely audience. Today we have the speaker from India. Today our speaker name is Dr. Babita Jha. She is Associate Professor, School of Business and Management from India. Let's welcome our speaker to the screen.
Thank you, sir.
Hello, ma'am.
Thank you, sir. Humbled by your words. So, can I start my session?
Yes, ma'am. You can start your presentation.
Okay. So, since I'm not able to see audience, so I suppose there is a good number of audience. Hello.
Yes, ma'am. We have now 37 participants already joined. I hope it's now increasing.
Okay, sir.
Thank you.
So, a very good evening to all of you. In India, it's 5:30 almost, 5:30 p.m. So, now before beginning, I would just like to brief more about myself. I'm basically a faculty in the area of mergers and acquisitions and valuation. So again, nowadays, like valuations, mergers, and acquisitions, they are a common phenomenon. So I thought of taking this topic to the crowd because these concepts should be clear with all the students, academicians, and whosoever wants to know more about acquisitions, mergers, and valuation. Because nowadays we are finding each and every, like in each and every month, we are having so many mergers, we are having so many acquisitions. So how do these companies go for mergers, acquisitions, and what is the valuation process? I thought I should bring this topic into limelight because again, since you people, if you are aware of this thing, certain things can be just be predicted, how valuation will go about, how what will be the consequence of this merger, what will be the consequence of this acquisitions. So like I'll be briefing you about mergers and acquisition initially, then I'll be dealing with the importance of business valuation in terms of mergers and acquisitions. So this is my first topic, that is mergers and acquisitions with special perspective to business valuation. Now, when we talk about mergers and acquisitions, basically we define the corporate, we are basically concerned about the corporate restructuring. Nowadays, many mergers, acquisitions, they are taking place with the motive of either gaining economies of scale or like increasing the market size, or like reducing cost, or some other motives are there, so that a merged company, or even if a company it is going for an acquisition, an acquirer and the acquirer becomes has a beneficial position. And that is why mergers and acquisitions, they are taking at a large scale. And let me tell you, most of the students and most of the people, they get confused between these two words, that is mergers and acquisitions. So there is a difference between acquisitions and mergers. Mergers, they basically it is basically described as two companies, or two entities, they are merging together, okay, and they basically have the same size, and they try to merge with each other to gain certain advantage, so that both the companies, they have certain advantage when they are merging together. And please to remember, in case of mergers, they have the same size, almost like if I say two companies, they are trying to merge it, they basically merge because they are of the equivalent size, and they want to gain something more, okay, because of this 2 plus 2 synergy. And like 1 plus 1, we say it is equal to 3 in case of synergy. So again, 2 plus 2, it is equal to 5 in case of synergy. So again, to gain from this thing, most of the mergers and acquisitions, they are taking place. Now in case of acquisitions, a larger company, it basically acquires a smaller company. So this is the basic difference. In case of mergers, it is of same size. In case of acquisition, please to remember, a larger company, it acquires a smaller company, and thereby the entity of the smaller company, it does not remain same as it used to be before. Now, if we talk about mergers, there are several classifications of mergers. So, if we normally say merger happened, okay, but did you ever realize which type of merger it was, or like what was the intention of getting that merger? So, the first merger which comes into mind is the horizontal merger. Now, again, please to remember one thing: two similar companies, in case of horizontal merger, actually there is a merger between two similar companies. Suppose I say, if Facebook, WhatsApp, and Instagram, okay, and Insta page, if they have merged together, so their business, or their particular entity, it was with respect to the messaging part. That means they were the messengers, okay, they were basically and they were involved in the social media, and that is why they merged together. So when two or three similar companies, they merge together, so please note down my word, that is similar companies, okay. So if they merge together, it becomes an horizontal merger. So you can quote an example of Facebook, WhatsApp, and Insta being merged together. Again, to gain the why these three entities they merge together, again, to gain the benefit of the market, to expand their customer, to earn more revenue, to reduce their cost. So they entered into horizontal merger. Then comes vertical merger. Now, vertical, as the word implies, there is something in the value chain which has to be added. Now, what is that something? Suppose if I talk about vertical merger, I will be taking the process which are being involved, or the chain which a particular product follows when it basically comes into a market. Suppose if I say I'm dealing with a wholesale business, but wholesale business, it is giving me somewhat of little profit. If I suppose enter into manufacturing of that product, and if I start manufacturing that product, and then if it comes to an wholesale business, I may have more advantage in terms of profit earning, in terms of cost cutting. So vertical merger, it involves taking on the process which are there in the manufacturing as well as in the selling of the commodities. So nowadays, vertical mergers, they have also become very common, and a very good example of this vertical merger you can see over here. That is a Walt Disney and Pixar this thing merger. Now, Walt Disney, as you all know, it is basically a show company, and Pixar, it is famous for the animation part. So it is good in animation and all these things. So Walt Disney thought, why not they merge with Pixar? Because again, Pixar will be producing animated films and all these things, and Walt Disney will be showcasing it. So again, if these two companies they merge together, the benefit will be that the customer base will increase, cost reduction will be there, again it will lead to higher revenue of both the merged companies. So that is why Walt Disney and Pixar, they merged in the year 2006 with the same intention, because Walt Disney, it was facing some issues in relation to broadcasting and all these things. So Pixar, it tried to merge with Pixar, because Pixar, it was well known for its animation and all these things, and that is why these two companies tried to merge with each other. Then we have this thing, that is uh, conglomerate merger. Now, in case of conglomerate merger, please to remember there are two companies who are merging, but their products, they are not similar in any ways. Okay, suppose if I say I am producing cement and I want to merge with a company producing soap, so these type of mergers, okay, they are not in relation, or their industry, they are not totally related with each other. So their products, they are different, but still they merge just because to acquire more market. They have an intention, like these companies, they have an intention, instead of acquiring one market, why not to acquire many markets in terms of different products. And that is why conglomerate merger, it is happening nowadays. And actually conglomerate merger, it is rising day by day. So again, if I take an example of conglomerate merger, we can talk merger of a cement company with a soap company. We can talk a cold drink company if it is merging with any company which is an unidentified company in an industry. So again, that may lead to conglomerate merger. Then comes a congeneric merger. Now, what is a congeneric merger? Now, as the word implies, that congeneric merger, it means they are the company. Okay, one company, it is producing a particular product. Other company, it is also producing a particular product. But please to remember, in these type of merger, the companies, they will be merging only when and when there are not this there is not a same product, but at least similar product. Okay, that means in case of conglomerate, what happened, there were two different products. Okay, they were entirely different. In this type of mergers, product will be somehow or the other, it will be similar, it may not be same, but it may be similar with the other product. Now, what will be the benefit of this thing? If two similar products, they are combining, they may have the advantage of economies of scale. Economies of scale, in the sense, like they will be able to, if these type of mergers, if it is taking place, it may be able to gain the advantage of market share, or it may be able to gain advantage of market revenue. So congeneric, in case of congeneric merger, please to remember one thing, new combined company, it is found in an industry. Thing is that they both deal with a similar product. Okay, so we can have an example, quick look over the example of congeneric this thing merger. Now, merger which took place in India, and that was, this is not an international merger, but it took place in India. Now, it was termed as a very major event, okay, in terms of merger, because Thomas Cook India Limited, it was basically a travel industry, okay. So, traveling means it was dealing with travels and all these things, okay. But Sterling Holiday Resort, as the name itself suggests, it is basically a resort. So, Thomas Cook India Limited, it thought of merging with Sterling Holiday Resort. Why? Because Thomas Cook, it was already in travel industry, wherein through which it can gain customers, okay, who were going for booking of these flights and the traveling and all these arrangements. Whereas Sterling Holiday Resort, it will provide the benefit to the customer by way of staying, by way of resorts and these things. So Thomas Cook and Sterling Holiday Resort thought of merging with each other to gain more customers, because Thomas Cook will be diverting its customer from its travel arrangement to Sterling Holiday Resort. So in this way, they both will be able to gain more customers, and more market will be gained with the help of this particular merger. So this is a congeneric merger. I hope you are able to get distinction between both these things, that is conglomerate and this congeneric merger. Then comes a market extension merger. Now, these mergers, they take place simply to expand their market. That means there is no other intention of product and all these extension, but the only intention which is there in case of market extension merger is that if I'm able to merge with this particular company, I will have to gain over more of market. Okay, that means suppose an Indian company, if it is acquiring a UK based company, or if it is going in merger with a UK based company, then naturally my simple motive or my simple intention will be to acquire more market, and that is why these companies, they try to merge with each other. So, in case of market extension merger, please do remember it's not that these companies, they are dealing with entirely different products. Simple aim or simple motive of any merger of these kind is to expand their market base and nothing else. They don't want to expand their product, they don't want to enter into new line of product and all these things. Only thing they want is to enter into new market or to expand their market. A classic example of this thing, it is Mittal Steel and Arcelor Steel. And this Mittal Steel, actually it went into an hostile takeover in Arcelor Steel, but somehow or the government, somehow or the other, government of in UK, it protested against this thing, that is Arcelor Steel merger and then acquisition. Then what happened? They both agreed into a merger wherein, like Mittal Steel and Arcelor Steel, they both will be acting as a merged company. And instead of a hostile takeover by Mittal Steel, it deemed proper that both the companies should merge instead of going for a takeover. So this was a classic example of market extension merger. Then comes reverse takeover. Now, this is a very recent type of mergers which are taking place, and these mergers, they are basically termed as reverse takeover because in this type of merger, basically what phenomena we have been observing for the quite number of years is that private companies, they are wanting to take over this thing, public limited companies. Now their intention, now you may be thinking why they are doing so. Now they are public listed companies, like private companies, all of you know, they are not listed in the share market or securities market, but public listed company, they are listed in the share market. Now private limited companies, they want to gain an advantage of listing, okay, in the shares. So instead of going for the fresh IPOs, instead of going for the fresh listing, so what these companies, they basically try to do, they basically try to go for the reverse takeover. Now they have their special this thing acquisition companies. Okay, this SPAC represents special purpose acquisition companies. So they have this thing, these special purpose acquisition companies for acquiring public limited companies. Now don't think a reverse takeover can take place only when private companies, they are acquiring public companies, okay, or public listed company. Instead of that, public limited company, they can also go for acquisition of private limited companies. But the most common phenomenon which we are observing nowadays is that private companies, they are going for public listed companies mergers. So again, we can see a classic example of this thing is this the acquisition of US Airways by America West in 2015. Okay, so again, America West, it merged with this thing, US Airways. So we call it as an acquisition, but actually it is termed as a reverse merger. Now, then comes acqui-hiring. Now, what do you understand by acqui-hiring? Now, acquisition done basically. Now, please remember again, this is a latest type of mergers, or this is the latest type of acquisition, also you can call, which is taking place just because to acquire or to take the employees of the existing company. Some companies, some good companies, okay, they may see a particular company having good employees with it, or they may have an intention of buying a CEO or or hiring a CEO of the other company. Now, what to do? Like directly can't go and tell him, ki, let me give you some remuneration. You come to our company, or the entire employee of this company come to our company. Okay, so instead of doing that, what these type of merger basically consist of, it simply means acquiring another company just with the intention of holding the employees of that particular company. Okay, so acquiring, it simply means acquisition with the intention of hiring the employees of the already established company. Now we have again a very good example of this thing. Facebook acquisition of Drop.io in 2010. Facebook, all of you know, it is a social media. This is a social media website which connects each and every individuals. Now, Drop.io, it is a file saving company. File saving in the sense they have cloud computing and all these things. So, through cloud serving in this thing, they are able to save data. So, Facebook acquisitions of Drop.io in 2010, it basically took place because of the CEO Sam Lesson. Okay, because they wanted that same Sam Lesson, he should come in their company, and what to do if he is not willing to come. So it's better to go for the mergers or go for the acquisition in this case, okay, which is termed as acqui-hiring. So please to remember, these are the different type of mergers which can take place at any point of time, and they are basically the most prevalent mergers which we are noticing nowadays. Apart from this, there are several other type of mergers, but I won't be dealing with those mergers, because again, I will be dealing only which are the popular mergers. So now comes this acquisition. I told you acquisitions and mergers, they are two different phenomena. So acquisition means acquiring the other company. Now acquisition, simply you can say, when a stronger company or when a larger company, it goes on buying the smaller companies, okay, that is termed as acquisition. Now again, acquisition can take place because of the stock purchase. Now if the other company is acquiring just because it has owned the stock of the acquiring company at a large stake, then it is known as stock purchase acquisition. Suppose A company, it is holding majority of the stock of the B company, okay, or it has acquired majority of the stock of B company. So again, this is termed as stock purchase. Now, second type of acquisition, it is termed as asset purchase. Now, as the name itself implies, asset purchase means when a company is purchasing asset of the other company just with the intention of acquiring that company. Okay, that is termed as asset purchase. So please to remember, acquisition can happen by either of the way, or the combined way also, like stock as well as purchase can also take place, but it can happen on either of the way also, that is by stock purchase or that is by asset purchase. In case of stock purchase, please to remember that it will be by way of equity acquisition, and in case of asset purchase, it will be by way of acquiring the assets. Now, what can be the advantages? Now, you may be thinking, why should a company go for mergers and acquisition? So, the first thing, please do remember, it is the major advantage for mergers and acquisition is to obtain synergy or to unlock synergies. Now, what are synergies? So, synergy means combination of two different units so that this particular benefit may be reaped by gaining more and more market and more and more more and more revenue. So unlocking synergies basically means 1 plus 1, it is equal to 3. So if two units they combine together, instead of doubling their profit, they may have more than double of the profit. So that is what is meant by synergies. Now why do these synergies occur? Please to remember, synergies basically occur because of economies of scale. Now, you might have heard this word, that is economies of scale. Now, economies of scale occurs when a company, it is operating at a very high level, and because of this high operational level, it is able to cover its fixed cost. There are two types of cost in any organization, that is the fixed cost and the variable cost. Variable cost, it keeps on varying as one more units of the goods are produced. Fixed cost, it remains fixed irrespective of the output produced. So higher the volume or higher the production if it takes place, fixed cost it get absorbed. So unlocking synergies, it basically occurs in mergers and acquisition because of this economies of scale. Now comes the second advantages of mergers and acquisition. So the second advantage, it is in terms of higher growth. So higher growth, obviously, if you are going for a merger, if you are going for an acquisition, you expect that market will grow like anything, because if one person is working and if two persons are working there, it makes a difference. Okay, individual person can't make more effort, can't put more effort in comparison to two individuals who are combining their effort. So growth, it is more if it is in a combined form. Okay, suppose if I say, if I talked about Facebook, Insta and WhatsApp, so if these three companies, if they have merged together, after merging, their growth, you can see it is much higher, not only in terms of market but also in terms of revenue earning. So obviously, if two or three companies they are merging together, their growth, it will not be only be in terms of revenue earning, but it will also be in terms of market shares. Then comes stronger market power. Now, stronger market power, if two or more companies they are operating together, then obviously market power will increase. Okay, so combined entity market power will increase instead of two companies operating individually. Okay, so that is why companies they prefer to go for mergers and acquisitions. Now we are seeing this merger and acquisition very commonly nowadays in terms of banks. Okay, so banks nowadays they are merging or they are being acquired by different banks at a very greater phase. Now have you ever thought why these are taking place at such a higher phase? So basically the main motive is growth. Main motive it is to obtain synergies, and one more thing is that cost reduction. And you might have seen net non performing assets in the bank's balance sheet. So also to remove or to reduce those non performing assets, banks are finding it good to get themselves merged with the other bank, or it being acquired by the other banks. Then comes the advantages of diversification. As I told you in my previous example of this thing, that is the steel companies which I talked about, in terms of, if you can recall, these steel companies, that is the merger between Mittal Steel and the Arcelor Steel. So why it happened, I told you, basically the basic purpose was market expansion. Okay, so again with the market expansion comes diversification. So diversification, uh, it is not only in terms of product diversification, it can be in terms of market diversification also. Product diversification, I told you, it usually occurs when you go for conglomerate diversification. That means when you are merging just because to produce different type of products. But apart from this product diversification, I gave you an example of market diversification also. So mergers can occur because of market diversification also. Then comes the advantage of tax benefit. So naturally, most of the companies operating in different countries, they want to gain an advantage of tax benefit. Now suppose if I know that the other country it is implying less rate of taxes on my corporate operation, then naturally I would try to merge with the other country's company. Why? To gain an advantage of tax. And it happens nowadays, companies they are not only vigilant, or they are not only conscious about their earnings also, but they are conscious about their tax saving also. So they want to gain an advantage of tax benefit. It may be in terms of this thing production, it may be in terms of interstate transfer, it may be in terms of intergeographical transfers, but they somehow or the other wants to get the benefit of tax. So tax benefit, again, it becomes an motive for mergers and acquisitions. Then comes about geographical or other capital investment. So, if I want more of capital investment, if I want to expand geographically, then again I will be thinking it in terms of mergers and acquisitions, because as an Indian investor, I won't be having so much of capital for investment. But as a foreign invest if I club with a foreign investor, I will be having good amount of investment with me. So this will be the basic advantage of my mergers and acquisitions. Now let me go through some of the largest mergers and acquisitions which happened all time, that is the mergers of Verizon and Vodafone, Heinz and Kraft, and Pfizer and Warner Lambert, AT&T and T, and Time Warner. So again, these were the larger mergers of all time, because somehow or the other their motive was to merge together just because of earning more revenue, having economies of scale, cost reduction, all these things. So, biggest mergers and acquisitions which happened in 2022, it is Microsoft acquiring Activation Blizzard, worth rupees, can you imagine it, worth rupees 68.7 billion. And even Vista Equity Partners, Evergreen Coast Capital acquired Citrix again for 16.5 billion. TD Bank acquires First Horizon for how much? $13.4 billion. Then Two Tech Interactive pays $12.7 billion for Farme Village developer Zynga. So these are the latest mergers and acquisitions which took place in the year 2022. Okay, so again, please do remember why I started with mergers and acquisitions, because whenever we are talking of about valuation, we basically look into different intentions of valuation. So valuation can be because some mergers are happening, some acquisitions are happening, some IPOs has to be issued in the market. Now, so before going into valuation, I thought proper to tell you more about mergers and acquisition. Then I thought of going into business valuation. So I hope that this session or this particular portion, with this particular portion, you were clear about what is mergers, what is acquisition, and what are the intentions of mergers and acquisitions. I hope audience they are cleared with this thing. So do I have an access to chats also? I don't think so. Okay. So because I am not able to see any chat, so I'm not able to get responses if anyone is having any doubts or these things. S- So I'm closing this big emerges and acquisition slides. Now I'll be dealing with the main part, that is the valuation. Mhm. Hello? Yeah. So, business valuation is basically the valuation of a business at a particular point of time. Now, if I say valuation of a business, I simply mean to say that I want to see how much worth of this particular business is. Okay, that means I just want to see how much in terms of this thing price, or in terms of certain other multiples, how much is the value of my business. Now please to remember one thing, when I'm talking about business valuation, there are several techniques, there are several tools for going into the valuation of a business. But please to remember one thing, at last when you are going for mergers, when you are going for acquisition, it's not necessary whatever values you have taken out from the valuation technique, your point of determination will be that only. That means if I say I'm able to get valuation of my business $1 lakh billion, okay, from a particular technique, it's not necessary that the other party who is acquiring my business, it will pay $1 billion only, 1 lakh billion only. It may happen that the value may go up, value may go down. Again, it depends on the negotiation, it depends on how we are going for the approach of our valuation, or how negotiation it is being done on the basis of valuation what you have done. So please to remember one common statement in case of valuation is that value always lies in the eyes of the beholder. That means whosoever is merging with you, which whosoever company is acquiring your company, the value or the real value of your company, it will lie in their eyes only. So that is why this proverb I have written, or the statement I have written, that is, value lies in the eyes of the beholder. Now, please to remember when we are talking about valuation, so valuation it is a generalized term. Okay, we say business valuation, but what under business valuation you are going for? So please to remember when we are talking about business valuation, we basically talk in terms of two type of valuation, that is the corporate valuation, and the other one is the equity valuation. Now you may think, what is the difference between corporate valuation and how come it is different from equity valuation? So let me tell you one thing. Corporate valuation means the valuation of an enterprise. Suppose I am owning a business and I may be having certain amount of assets with me. So the valuation of those assets based on the market value, that can give you a corporate valuation. Similarly, I may see the earnings of my business. Suppose I have this profit and loss statement with me. So, with the help of this profit and loss statement, I can see my operating income, I can see my operating expenses, I can see different type of expenses which are being involved by way of capital expenditure, by way of working capital expenses, and I may be able to see the real corporate value or the value of my enterprise. So please do remember, whenever you are going for the valuation of your enterprise or of your corporate, that is termed as corporate valuation. Suppose I want to say I am value XYZ business. So if I'm going for XYZ valuation of a particular business, it is termed as corporate valuation. But if I am concerned with the valuation of the equity of that particular corporate, okay, suppose XYZ has issued some equity in the market, okay, so it is a public listed company and it has issued some equity in the market. If I am concerned about the valuation of those equity, then it will be termed as equity valuation. So please to remember, whenever we are talking about business valuation, we talk in terms of two things, that is corporate valuation or equity valuation. Through either of these way, you can take out your business valuation. Now, uh, please to remember, corporate valuation, it is basically the process, okay, it is not the means, but it is basically the process of determining the economic value or the real value of your business based on the model of business on which you are running. That means, a model of business means what is the source of your income of this particular business, what is who are your customers, then how it is producing, which type of technology it is using. So this becomes business model. Secondly, it is linked with external environment. So whenever you are determining business valuation or corporate valuation or enterprise valuation, you not only look into the business strengths, weakness, and all these things, but you also are concerned with external environment, because any business, it is taking place in an environment which consists of not only internal environment but also of external environments like legal, political, social, economic, and all these environments. So you are required to take these environment into consideration while going for the valuation of your business. Now, please to remember, if we are going for corporate valuation, so basically the type of techniques or tools which we will be applying for the valuation, it will be dependent not only the tools and techniques which are available, but it will be determined on the basis of the factors which are available for determining your corporate valuation. Okay, so the factors which are available for determining your corporate valuation is, firstly, is purpose of valuation. Now I told you valuation can take place for anything. Okay, suppose if I want to merge my company with the other company, I may go for a valuation. If I want to acquire the other company, I may see the acquired company's valuation. If I want to issue IPOs in the market, again I can go for the valuation. Even simply if I want to see my valuation at a particular point of time, again I can go for the valuation of my company. So purpose of valuation, it is the first and the foremost factors which helps you in determining corporate valuation. Because if you want to go for acquisition, you may be forecasting other companies figure in a different manner. If you want to see your own performance at a particular point of time, you may be forecasting your company's valuation in other manner. Okay, so please to remember, valuation, when we're talking about valuation, it is simply seeing the valuation of a company in the coming future with reference to your present value. Now comes the second factor, that is the stage of business. Again, this becomes very important in terms of valuation. Now, suppose if I say your business, it is in maturity stage, so naturally your valuation of your business, it will be lesser. That means the value, if you are getting, if you try to sell off your business, or if you are trying to acquire, if you are trying to get it acquired by other companies, or if you are trying to merge with the other company, your valuation will naturally be lesser. But if it is in the growth stage, your business will give you high value. Why? Because there is a perspective that the values of our company, it may grow up in the coming future in terms of earnings, in terms of assets, and all these things. So again, stage of business plays an important role when you are going for a corporate valuation. Next comes past financial. So, past financial simply means if you are going for the forecasting of your upcoming performance, so you should be naturally concerned about seeing your previous performance. Okay, that means if I want the value of my business to be this much, okay, in the coming future, or if I am concerned about the value of my business at a particular point of time, what I should be seeing, I should be basically concerned with my previous year's figure also. Let me quote an example. Suppose I say net operating income of my company over the 5 years, it is growing by almost on an average 15% each and every year. So it's a good indication for a company running in an industry that its operating income, it is growing year by year at a particular rate of at a particular annual growth rate. But if suppose I say net operating income of my company, it is declining each and every year constantly. So naturally, what it is reflecting that I will not be able to get good value of my company. Why I won't be able to get good value of my company? Because my past financials, they are not so good. It is not a good. They are not giving a good indication. So that is why valuation, again, it is dependent on your past financial. Now, I told you basically you go for the valuation based on future earning, and these future earnings, they are based on the past financial. That means we try to forecast our earnings, and these forecasted earnings, they are based on our previous performance. So expected financial results, again, is an important factor in determining your valuation of your business. Now, if I say I am expecting a rise of 23% in my operating income in the next 5 years, so naturally an acquirer will think, oh great, that's a great thing, that this target company, it will be increasing its income over the number of years. So I should be paying more amount to this target company, because I very well know they will be increasing their income in the coming future. So again, your valuation may go up. Similarly, if two companies they are merging, so again in case of mergers also, their valuation comes into scene. So if valuation it is high, naturally the company shareholders will be benefited, company's management will be benefited in some way or the other. Then comes industry scenario. Now this is again a very important perspective, okay, when you are going for corporate valuation. Now what do you understand by industry scenario? Any business it is related with a particular industry. Okay, suppose if I talk about car, so it is related with automobile industry. If I talk about any phone, okay, so suppose if I talk about Apple or these type of or any other phone, so these smartphones or these phones they are connected with telecom industries. So again, the type of industry in which you are operating will be very helpful in determining valuation of your business. Now why I am saying so? Because if your industry it is in the declining phase, because industry again has its own life, that is introductory, then again it may reach as at a growth, then maturity, then stagnant, and then it may decline. So again, if it is in the declining phase, no investor would like to invest in your company because they know already industry it is declining, and so industry performance will be reflected in the company's performance also. So why to invest in these type of companies? So what will happen? Naturally, you when at the time of acquisitions, at the time of mergers, or even at the time of issuing IPOs, you may not be able to satisfy your shareholders or stakeholders. So that is why your company valuation it may go down at the time of determining the value of your company. Now, after going into factors, so again, please to remember the purpose of valuation. So I told you acquisitions simply to acquire different companies. Okay, you may be going for valuation. Now, in this thing, please to remember whenever any company acquires the other companies, okay, both the companies they go for valuation. That is, acquirer will have their own figure, target company will have their own figure. Acquirer will value company on the basis of something, target company will also be going for the valuation on the basis of something. These both parties they will negotiate with each other, and accordingly target company will get some consideration for its acquisition. So this is the basic purpose of valuation. Then comes divestitures. So divestitures simply means if you are planning to sell off your company, if you're planning to liquidate, or if you're planning to sell off one unit of your company, then again comes valuation. Now, please do remember at this point of time when you are going for a valuation, you should be very conscious about recording of each of earnings, each assets, or whatever capital expenditure you are bearing. Why I am saying so? Because in case of divestitures, a selling party will always like that the value of their company it should be highly estimated, okay, or they should get a good price of their company, wherein the party who is buying it will always like that the value it should be quoted at a lowest possible price. So there comes a difference. The other party will bring a lowest quotation, the seller party will bring a highest quotation. Now in between these quotation will lie the value of negotiation. So you should be very conscious when you are going for the valuation at the time of the liquidation or at the time of sell off of your company. Then comes PSU disinvestment. So some of the public sector undertakings which are public sector companies. Okay, so public sector companies, as all of you know, the majority of the shares it is being owned by the government, and very least amount it is owned by the private companies. So again, these PSUs, because most of the PSUs in our country they are having losses. Even in several other countries they are running on losses, and government it is thinking better to hand it over to, or better to go for privatization. So again, PSU disinvestment leads to this thing, the valuation of your company, because you can't go for disinvestment until or unless valuation of your company has been done. Then comes IPOs. So IPOs means initial public offerings. So whenever company it wants to raise new shares from the equity market, from the share market. It issues IPOs, that is initial public offerings. So again, valuation of these initial public offerings, they are being based on the valuation of the securities, which is connected with the valuation of your business. So again, valuation comes into scene. Then comes, if you have a nascent venture, that means if you have a new venture which is at a very starting phase, then again you may be required to raise certain amount of capital from the market. So what you will be doing, you will be going for the valuation. Now, what are the approaches to corporate valuation? Now, this is very important when you're going for mergers, when you're going for acquisition, when you are going for the liquidation or like IPOs offering. Okay, there are n number of approaches which are available in the market for valuation. Now, be aware of this thing. Any wrong valuation may lead to wrong value of your company. So, whenever you are adopting any technique of valuation, adopt it very rationally. Don't just go on a vague manner that I want to adopt this particular technique because this is a very famous technique. Don't go by this way. Instead of this, just see the purpose of your valuation. Why do you want to go for valuation? Accordingly, try to value on the approaches which are available for this thing that is that is for corporate valuation. Please to remember one thing: when you are going for valuation, it's not necessary you are taking only one approach of valuation into consideration. You can take two or three approaches of valuation into consideration depending on the purpose, on the need of your valuation. So, the first approach to corporate valuation is the book value approach. Now, as the word itself suggests, book value takes into consideration the value of your assets. Okay, that means whatever assets you have in your this thing, financial statement, in your balance sheet. Okay, you value it, you just see the book value of those assets, and then you try to find out the valuation of your company. Again, this is not so common method because book value, again, it won't be giving you the real value of your business. Then come stock and debt approach. In case of stock and debt approach, you take equity valuation and debt valuation in terms of market value into consideration. That means you take stock into consideration, you take debt into consideration, but the valuation, it is basically done on the basis of market value. So again, whatever value it is being arrived because of this particular approach, it will be the valuation of your corporate. Okay, so this value you can take it as a basis of negotiation when you're going to the other party. Then comes discounted cash flow. Now, this is a very important technique, and this is a very popular technique which all of you should know if you are interested in valuation part. Now, as the word itself suggests, discounted cash flow means you are discounting your cash flows. Now, what are these cash flows? Cash flows simply means the cash inflows which will be there in your organization and cash outflows which will be there from your organization. Now, should it be a general cash flow or there should be some measure of cash flow? So I will be saying there should be some measure of cash flow. We basically take into account operating income, okay, that is EBIT 1 minus tax rate for considering our cash flow. Okay, in case of valuation of a company. Okay, so if you are going for the valuation of a company, we take, that is free cash flow into or to firm into consideration, wherein we take operating income into consideration. Other type of outflows which we take into consideration is by way of capital expenditure and by way of working capital investment. in case of valuation of a company. Now, before going into the depth of this method, let me be very clear with one thing. When you are going for the valuation of the company, that too in terms of discounted cash flow approach, you have to look into the free cash flow to the firm, okay, when you are going for the enterprise valuation. But I told you corporate valuation, it not only consists of enterprise valuation, it also consists of equity valuation. So when you are going for equity valuation, please look into free cash flow to the equity. Okay, so again I'm repeating, when we are going for this thing that is corporate valuation, we basically go into this thing that is free cash flow to the firm. When we are going for this thing equity valuation, we basically look into free cash flow to the equity. Now what is this free cash flow to the firm? Free cash flow to the firm, please to remember, it consists of earnings before interest and taxes, then 1 minus taxes, that is simply operating profit after paying of taxes. Then from this thing, you will be deducting any of the capital expenditure you have made, and you will be adding if you have sold off any capital expenditure, any capital investment in the coming future, and any working capital investment which you are planning to do in the coming future. So please do remember, in case of FCFF, you will be getting business valuation. In case of FCFE, you will be getting equity valuation. And FCFE, that is free cash flow to the equity, it consists of net income plus all your capital. If you are selling your capital investment, then plus capital investment minus any sell off of your capital investment. If you are investing in working capital, deduct it, and some portion of debt, it is also to be taken into account. That means if you have taken some debt amount, then you will be adding it. If you are planning to redeem some of the debentures or debt, then you should be deducting it. So we get an FCFF or FCFE figure. This FCFF or FCFE figure has to be discounted with a discounting factor. Now, what should be this discounted factor? Discounting factor simply means that factor which will bring the future value of your earnings into the current value or into the present value. We call it as a present value. In finance, we use this word as present value. So please to remember, discounting factor is any factor which helps in bringing the future value of your earnings to the present value. Okay, so discounted cash flow approach takes into consideration discounting factor as weighted average cost of capital in case of this thing business valuation, and in case of equity valuation, it takes into consideration cost of equity. So please do remember one thing, in case of business valuation, FCFF is being discounted by the cost of capital, that is the weighted average cost of capital. And in case of equity valuation, FCFE, that is free cash flow to the equity, will be discounted by the cost of equity. Okay, so this is, so after discounting, whatever value you get, okay, that will give you the present value of business. So discounted cash flow approach, it basically sees the forecasted earnings based on previous earnings, and it takes into consideration a discounting factor. Okay, now comes relative valuation approach. Now, relative valuation approach takes into consideration the multiple figure. Okay, suppose if I talk, or if I say price oblique earnings multiple. So, what are these multiples? These multiples are basically an indicator of the growth of this company in the coming future. Okay, so suppose if I say I'm getting 2.3 as my P. So 2.3 multiple means, that means my price in comparison to my earnings, it will grow by 2.3 times. So any multiples, okay, which will give you certain figures in terms of business valuation, in terms of equity valuation, they find their place in relative valuation approach. Now, there can be different type of multiples. They can be, there's not only, students usually think that there is only P oblique E multiple, that is price oblique earnings multiples, but there is price oblique sales multiple also. There is other multiples by way of business valuation, that is the earnings upon this thing, EBITDA. If you might have heard this word, that is earning before interest and taxes, depreciation, and this thing, so amortization. So again, multiples, they are based on different factors, and here you don't get an absolute figure, you get your figure in terms of relation, in terms of relative figure. In discounted cash flow approach, you get it in terms of a particular absolute figure. By absolute, I mean to say in terms of dollars this much, okay, dollars this much million, pounds this much million, rupees this much million, taka this much million, okay. So this is how we'll be getting. But in case of relative valuation approach, we will be getting it only in terms of multiples, that is in terms of ratios or times we call it. Then comes option valuation approach. In case of option, again, options, they are basically the derivatives and all these tools. And this is again a very, I won't be able to explain in such a smaller time, but I'll tell you. Now, these are basically a risk hedging techniques, okay, which are being used. So option valuation approach takes different scenarios into consideration, and based on the scenarios, it tries to values a particular business. So again, let me be very clear. Approaches to corporate valuation, it will depend on the type of industry, on the type of company which you are having, okay. You can't apply, like if I told you, you can't apply the relative valuation approach to all the type of companies. Similarly, you can't apply discounted cash flow approach to all the type of companies. If you are having loss, then you won't be able to apply discounted cash flow approach. You may be able to apply price relative approach or the book value approach or other types of approaches. So all the approaches can't be together be used, and it depends on the requirement of the valuator. So basically, these are the valuation techniques which we use in practice. That is discounted cash flow technique. I told you this is the most relevant, this is the most common technique nowadays, and it is very popular nowadays, okay, because most of the companies, when they are going for valuation, they basically base their valuation on discounted cash flow techniques. Relative valuation also will give you your value in terms of this thing, multiples. So again, it has become very common. You might have heard this thing also, EV upon BV multiple, that is enterprise value upon book value multiples. I think this audience is, most of you might be a finance background, so you might have heard this word. Then price oblique sales multiple, so these will give you in terms of times. So again, this practice, it is very good because some of the e-commerce companies, they are having losses and they are not able to take this discounted cash flow valuation into account. So if they take discounted cash flow technique into account, their earnings, it is almost in negative figure. They won't be able to get good value of their business. So what they do, instead of going for discounted cash flow approach, they rather prefer this relative valuation approach. Then transaction multiples. So again, multiples in terms of times. Again, transactions, how much transaction will increase in the coming future, how much growth of the company will be there in the coming future. So we can take this into account while going for valuation of the company. So this is all from my side in terms of mergers and acquisition and in terms of corporate valuation. So I would request our IGP teams if they can go for the question answer round, or if they can show me some of the chat in the chat box. I suppose the session was clear.
Thank you, ma'am, for your wonderful presentation. I hope
Thank you,
our
sir.
participants learn something new from you. Thank you, ma'am.
Thank you, sir.
Ma'am, now after a short video clip, we come back again with our question and answer session. Okay, ma'am?
Okay.
Na-
Yes, sir.
Okay, ma'am. Dear participants, now we are question and answer session time. You can send your question in the comment box. Our speaker are ready to answer the question. So if you have any question related to this topic, you can ask the question in the comment box. Ma'am, we are waiting for the question.
You're getting some questions, sir?
No, ma'am, we are also now waiting.
Okay.
Okay, ma'am. Our first question is, what is the difference between a business valuation and a business appraisal?
Appraisal. Yeah. So, business valuation basically involves valuation based on certain parameters at a particular point of time. Now, appraisal means again appraisal. Business valuation appraisal can be done for valuation. Okay, so suppose business valuation, it is a very broader term. So whenever you want to appraise your business, or whenever you want to see how well my business it is going and these things, so again business valuation techniques, they can be applied for an appraisal. So appraisal basically means you are trying to appraise your business. You are basically seeing, you are basically concerned about seeing how well my business it is running. Okay, so business appraisal can be done on the basis of business valuation also. That means you are trying to appraise business on the basis of valuation figure which you are getting. Okay, so again I told you, valuation it may be based on your assets, life, on your earnings and these things. So these this is the difference between appraisal and valuation. For appraisal purpose, valuation techniques it is required. What challenges are faced with? Yeah, lots of challenges. Okay, they are faced with mergers and acquisition. The first and foremost challenge is, suppose if two is the basic point of negotiation. So negotiation, like two, I told you, two companies, they are bringing two different figures with them. Okay, and both the companies, they want to have a common point of, or a common negotiated thing. So again negotiation it becomes very difficult. Secondly, if there are different geographical, if they are located in different geographical units, so again the restrictions, the legal bindings which are there, again it creates a challenge. Third, the type of this mergers and acquisitions which we have seen, sometimes what happens there, after merging, okay, basically this happens after merging. It is usually seen that two companies, though they have merged together, but they are not able to perform well. Why? Because there are differences of opinion in the management of the two bodies. So again this may lead to a failure. Then there are certain restrictions by way of government in terms of tax and all these things, and even in terms of entry norms and all these things. So again these are the challenges which are there. But the initial challenges as an analyst, it is in terms of the negotiation price, it is very difficult. Okay, in terms, I have talked about business valuation, I told you this is how it is computed, but sometimes value may go very far. So again this is the major challenge. Okay, vertical merger and conglomerate merger. So, vertical merger, I told you, it will be adding value to what your to your operating what at presently what your company it is into. So, adding value in the sense, suppose I am a distributor of a particular product. I know I have wholesaler. I know I have a manufacturer. So why not to acquire, or why not to merge my business, or why not to get into this thing, merging with a particular business, or which exists in manufacturing, which exists in this thing, that is the wholesaling and all these things, and later on I can distribute it. So vertical means you are adding value to your chain. Okay, so addition of value in your chain, it is termed as vertical. Conglomerate means you are like vertical, it will occur with similar product, the chain you are acquiring. Okay, so it can be upside, it can be lower side also. You are a manufacturer, you may plan to distribute your product yourself, but in case if you are a distributor, hello, hello,
Yes, ma'am.
am I audible? Yeah,
Yes,
yeah.
ma'am, you are ready.
Okay, I thought this live telecast it has ended. Okay, so in case of this thing vertical, you are simply adding value. But in case of conglomerate, please to remember, a company merge with the company which is having an entirely different product. Okay, I quoted an example of, suppose, let's take a very simple example, a soda company merging with a cement company. So this is an extreme example. Okay, conglomerate, little bit differences can be there, but in terms of extensive difference, these differences may arise at this extent also. So this is the difference between conglomerate and vertical. Vertical, please to remember, we are following the chain. Conglomerate means entirely different. Okay. Again, what factors those regulatory authority consider on making a decision merge? See, again, it depends on the country on which it is operating. So actually, I am an Indian this thing, so speaker. So I can talk in terms of Indian speaker. So if suppose I say we are nowadays promoting as an Indian economy is promoting foreign investment, okay, and even mergers and acquisitions, it is being promoted. Why? Because we want to expand our economy. So certain norms with relation to certain products, it is being liberalized. Okay, liberalized in the sense some documentation formalities, some payment formalities, like some of the governments, they are imposing these things in the merged companies, or in terms of acquisition, these governments, they are saying you are required to take the employee of the existing companies, or you can't play with the equity shareholders, you are required to take equity, you are required to give equity holdings of this much. So again, these type of regulations, they are being imposed by the type of government in which a particular merger or acquisition it is taking place. So in terms of talking about in terms of Indian context, there are restriction, okay, in terms of mergers and acquisition, by way of, again, exploiting the human resources, by way of certain legal formalities, by way of external environment, in the sense stakeholders who are being associated with this particular company. So naturally it will depend on this thing, that is the country in which you are operating.
Thank you, ma'am. We have no more questions. Thank you very much for your wonderful answer, and also thank
Thank
you
you.
for sharing your valuable knowledge with our participants. Thank you, ma'am.
Thank you, sir. Thank you for giving me
Thank,
this golden opportunity. I'm thankful to my participants for their patience listening. Thank you to all of you. If I could help you in future also, please do let me know. Thank you.
obviously, ma'am. We hope we'll meet together in another session in IGP platform.
Yeah. You can share
Thank
my
you.
mail ID also with all the participants, sir, in case if they want to have more this thing, because I was not able to cover entire thing on valuation. It is in very depth. So in case if they want to have some individual this thing also advice, they can ask me.
Okay,
Okay.
ma'am.
Okay, sir. Thank you, sir.
Thank you, ma'am. Dear participants, today our program name is Business Valuation, Mergers and Acquisition. And today our webinar code is IGP 9876. The code is IGP 9876. Without code, no one is eligible for certificate. With code, you can claim your certificate anytime from our website. Our website address is eduigp.com. To download your certificate, first of all, you have to go to our website, then you have to create an account, and after that, you have to enroll the program. And our program name is Business Valuation, Mergers and Acquisition. And after that, you have to put the code, and the code is IGP 9876. And after that, you can download your e-certificate. And after downloading your e-certificate, don't forget to celebrate with IGP checking. Thank you everyone for joining this session and make this webinar successful. Before ending the program, I request everyone you like our Facebook page and subscribe our YouTube channel for upcoming information. Thank you everyone. Stay happy and stay safe.